Welcome to the session. Topic of this session is preparation of income statement and cash flow statement. You know the many agriculture projects which are having the the commercial aspect or business aspect like any private or government sector the business projects or the business company projects and the performance of this the commercial project or the business project need to be assessed in a in a in a manner in which we assess the financial performance of the commercial project, the business project. So to assess the financial performance of the agriculture project, we need to prepare the different financial statement and the financial ratios which shows their financial strength, and the balance sheet, the income statement and cash flow statement, they are the common and the financial instrument used to show the to express the financial strength or financial soundness of a project. And the balance sheet basically which shows the assets, the liability or equity of a firm and on a particular debt, and that is basically shows the resources the company or firm has, the whatever the assets they have, the and then what are the liabilities, so whatever they have to pay to the other so liabilities, and what is the contribution or profit of that the business of firms or the commercial firms which have been invested in the organization, that is basically equity. So the balance sheet shows the assets, liability and equity. And basically in this session we are going to discuss about the preparation of the income statement and cash flow statement. And income statement basically shows the revenues, the expenses or the profit or loss of a firm on in a particular accounting period, and generally on the quarterly basis or on an annual basis. And then we will be also having a discussion on the cash flow statement. So basically the cash flow statement we show the flow of the resources, flow of the cash in a firm, and also the outflow, the going of the cash from the company or from the firm to the other. That is also we are going to reflect in the cash flow statement. So basically cash flow statement shows the cash management situation of the firm. And so basically in this session we will be focusing on the income statement and cash flow statement. So let us start with the income statement. So income statement is also called as a profit and loss statement, and basically it shows the financial performance of a business over a period of time, say 1 year for a quarter period. And basically it's reflect or it's report the profitable and profit of a business for a particular time period of time. So how the profit is being generated in a business, that is reflected through the income statement. And basically it presents the a summary of an enterprise's operations during the accounting period on basically three aspects. One is the revenue. We can also call the revenue as a sales, and the expenses, and then profit, or there may be loss also. So in case of the income statement, basically it is prepared in two format, the horizontal or the vertical formats. And when we have when we talk about the horizontal, the format of income statement, and all the expenses are debited, and that is we show the all the expenses on the debt side, or that is left side of the table, and then all the income are credited, that is basically on we show on the credit side or right hand side of the table. And the profit, whatever the profit basically is a difference between the revenue, between the the revenue and expenses, that is income and expenses, that is credited to the reserve account, and so that is also there in the income statement. So basically, when we talk about the income statement, it is prepared on the accrual basis. So accrual basis means all the expenses incurred or dues. So whatever the expenses, we have already made or we are going to be made, that are debited, whether they are actually paid or not. So whether we have made the payment or not, but whatever the expenses we have already incurred in the in the organization, we have to that is the part of the income statement. Similarly, all the income earned or dues are credited whether they are actually received or not. So whatever the income, whatever the sale we have done, whether payment for that sale has been received or not, we have to incorporate, we have to add in the income of the firm. So basically, actual payment or actual receipt is not a criteria for the reporting, for the recording of transaction in the income statement. Whatever sale, the payment received or not, that doesn't matter. So whatever the transaction we have done in a year or in a quarter, that we have to reflect in the entry of the income statement. So now we will discuss about the first component of the income statement, that is the revenue, and it is the basically amount which enterprise receive from the selling goods or providing services to its customer. So whatever the selling is being done by the a firm or by a company, that is basically form a part of the revenue. And there are two types of revenue, we can say. One is the operating revenue, another is non-operating revenue. And operating revenue is basically the selling the product or offering the services. So whatever the receipt due to the selling of the products, they are part of the revenue and the operating revenue. And then there are some secondary source of income, like the interest on the deposit or fixed deposit, or rent, or some machinery or some building, and the company or firm have, that is also part of the revenue, but they are treated as non-operating revenue. And then again, basically other incomes are also there, like we, if you have some machinery or idle machinery is there, and if you sell that machinery, if you sell some property of the firm, so that is basically other gain. So with that other gain is also included in the revenue. So revenue, I know whether it's earned or it's reported, whether they are not actually received the the cash or paid out, they are part of the the revenue. So like basically we include all the items on the accrual basis. So whether we have received the money or not, that is also part of the revenue. And in both cash or non-cash revenue, both the things they are included in the revenue stream. Then expenses, the expenditure incurred by enterprises or firm in earning revenue during the accounting year are called expenses. So whatever the expenses in terms of cost of production, in terms of selling the item, and the administrative costs, payment of salary, all these are, they form the part of the expense. So again there are two types. One is the operating expenses, another is non-operating expenses. So operating expenses are basically the expenses on the primary activity, like the cost of goods sold. So like if we talk about the agricultural product or in the farm produce, so the seed cost, the fertilizer cost, the electricity cost, so all types of cost, the labor cost, they are from the part of the basically primary activity for the production. So they form the the operating costs. Then selling and administrative cost, the marketing cost, the and some fees is going to be paid to the marketing organization or some commission agents. They are also part of the operating expenses, and depreciation also included here, because if you are using some machinery and there is some wear and tear so in the machineries, so that we have to include in the operating cost. Then we have the non-operating cost expenses like interest paid on the loan. So here if we are taking some loans and that has to be paid, so that is from the non-operating costs, the expenses. And then losses is other cost, like on one-time cost, or like if we have some machinery and there is a wear and tear or something there, so there is a loss in the long-time assets. There was some assets which we have lost in this particular area, so that is also basically losses, so that is also included in the expenses. And then profit. So basically this figure arrived at when the expenses are subtracted from the revenue. So for getting the profit figure, we minus the expenses from the revenue. So revenue minus expenses is basically the profit. And if expenses exceed the revenue, then firm will incur a loss. So and then we have the minus profit, or that we have to say, like there is a loss if the expenses is more than the revenue. And the profit is determined by matching the revenue and expenses during the same accounting period. And basically the say profit or loss, or basically income statement, is a scoreboard of the firm's performance during an accounting period. So from this figure of the profit, we can judge the financial position of the firm. So that is the basically scoreboard, and from this scoreboard we can have an idea. We can judge the firm, their operations, their strength, the financial strength. And here we have example, like we have prepared a hypothetical income statement, the profit and loss statement for a dal mill, we can say, like that is basically agro processing unit, and for the years ending on 31st March 2020. So here you see first we have prepared the revenue stream. So here in case of revenue, there are revenue from two sources. First is the sale of the dal, then sale of the husk. So the sale of the dal is we can say 3 lakhs rupees, and the sale of husk 50,000 rupees. So total revenue is 3,50,000. And then we calculate here case operating expenses like the raw material. So here raw material is 1,80,000. Factory variable cost, like electricity cost, then wages, labor cost. So the variable cost is around 30,000, and factory overhead cost, like depreciation. So they are around 15,000. So here total cost of goods sold is become 2,25,000, and so that is the total cost of the goods sold. So 1,80,000 plus 30,000 plus 15,000, they comes to 2,25,000. So here we can calculate the gross profit, that is 3,50,000 minus 1,25,000, 3,50,000 minus 2,25,000, that comes to 1,25,000. That is gross profit margin. And now for calculating the cost of the goods sold and the other cost of the selling the goods, like selling, general and administrative expenses, we have the selling cost is 30,000, we can say. Then there is a management fee, and that is 15,000. So total selling, general and administrative cost is 45,000. So operating profit before depreciation, we can say 1,25,000 minus this 45,000. So 80,000 rupees is the operating profit before depreciation. And so here when we include the depreciation, that is a non-cash operating expenses, that is 28,000. So total operating expenses comes like the 2,25,000 plus the 45,000 in the for selling cost, and plus 28,000 as a depreciation cost. So total operating expenses is to 2,98,000, and the operating income or operating the profit is 350 3,50,000 minus 2,98,000, so it's come to 52,000. And for calculating the net operating income and expenses, like we have the interest payment of 3,000 rupees. Then we have the interest paid of 5,000 rupees, and then the total operating expenses is comes to 2,000 rupees. So profit before tax is comes to 50,000. Then there is an income tax. For suppose we have the income tax at the rate of 20%. So the 10,000 is the income tax payment. So net income after tax is comes to 40,000. So 40,000 is the profit figure. From this figures, we can judge the performance of a firm. So in case of dal mill, we can say the business is in profitable condition, and the income is there, and there is positive income of the dal mill. Then this is another example where there is the income statement or profit and loss statement is presented in the horizontal forms, and basically two sides. The left hand side we have presented the debt, and the right hand side we have presented the credit. Figure is given in the rupees. So so in debt side we have given the various expenses. So expenses in terms of salary, that is 30,000, for printing and stationery cost 15,000, the postage and telephone cost 2,500, the audit fees is 4,000, the office rent is 5,000, insurance is 10,000. So repair and maintenance cost is 5,000, the general expenses 4,000, and interest on loan is 8,000. So and then on the other side we have presented the gross profit, that is 2,25,000, the rent received, that is basically other income, so 2,000. Then there is other incomes like 10,000, other income in terms of interest subsidies or some agriculture loan, and some power charge refunded by the government. So so total revenue here is 2,30,000. So when we minus all the cost from the gross revenue, that is 2,37,000. So net profits that is comes out to be 1,50,000, 53,500, that we transfer to the reserve or capital account of the firm. So here we can say the profit or income of the firm here is 1,53,500. So that is, we can say, the sound position. Then another one more exercise to understand the calculation of or the preparation of the income statement, and there are some data are given like sales 30,000, sales return, and that is 5,000, the cost of goods sold the 7,000, the operating expense is 8,000, and income interest income is 4,000. So these are the 5 figure is given, and we have to prepare the income statement in the vertical form. And here simply to understand, so revenue, we have the sales revenue, that is 30,000, and then we have to minus the sales return, that is the goods sold, but that has been returned back to the the company or firm. So we have to reduce that sales return, that is 5,000. So net sale is 25,000, and then the cost of goods sold is 7,000. So gross profits is come out to be 18,000 rupees, and then we have to minus the operating expenses, that is 8,000. So operating incomes come out to be 10,000, and then we have to add here the other incomes. So like we have received the interest income of 4,000, so net income or the profit of the firm is 14,000. So in this way we can prepare the profit and loss account or the income statement. Now we'll move to the cash flow statement. And cash flow statement is also known as basically the source and usage of fund statement, the sources and application of fund statement, or sometimes simply we can say the fund statement. And the basically it highlights the movement of investment fund over the life of the project. So it basically, the how funds are coming or how funds are going from the firm that we highlight here. So basically it summarizes the amount of cash or cash equivalent that is entering into the firm or that is leaving the firm. So basically cash flow statement, it measures the total flow of the financial resources into the firm. So it measures into and out of enterprises. It measures the funds which are coming into and which are going out of an enterprise during an accounting period, and it is used for projecting the total flow into the future. So what will be the future position we can project using the cash flow statement. So basically it measures how well a firm manages its cash to meet the obligations. Like we have different obligations. Actually we have to meet, like operating expenses, loan payments. So all this meeting the cash obligations, that's things is presented in the cash flow statement. So basically it shows, the cash flow statement shows the source of money coming. What are the different sources from which money is coming to the firm or to a company, or and then how we are utilizing this money which are coming to the firm. So basically this is the outgoing of the money from the company we reflect through the cash flow statement. Actually, the cash flows are generated in a firm from three activities. One is the operating activities, like the flow of cash due to the normal operation of business, like selling of the produce or interest earning on the on the fixed deposit, or payment of interest on the loan amount, or payment of salary and wages to the workers or the employees who are working in the firm. Then tax payment, like income tax payment to the government, or the rent we are paying to, if we are hiring some building, or if we are giving some building on rent to others. So rent income also, or the rent expenses can also be included in the cash flow statement. So that is basically operating activity. Then we have the investment activity. Flow of cash due to the purchase and sale of income producing assets. So whenever if we are purchasing some assets, so we are investing some money. If we are selling some assets, then we are getting some money. So that is also reflected in the cash flow statement. Then we have the financing activity, like flow cash between the owners and creditor. Like if you are getting some loan from the bank, so that is basically the fund is coming to the company. If you are making the repayment to the company, the principal we are paying, so that is means the fund is going from the firms to the bank. So there are three different activities from which this cash flow appear, like operating activity, investment activity, and financing activity. And the cash flow statement is basically prepared from the entries in the balance sheet and the income statement. So basically we use the information generated at the balance sheet and the income statement for preparing the cash flow statement. And the format of cash flow statement include all the items of the inflows and outflows. So whatever the items of inflows and the outflows are there, they should be included. They should be part of the cash flow statement. So now again we have the hypothetical example of the dal mill, and basically we have presented data for the 2019, but we can project the data for 2020, 2021, 2022. So that wise we can we can project the data. And basically, so first let us start. So what are the different inflows, from what are the different sources from which the money is flowing in the dal mills. So there are different sources of the inflows, like funds from the operating operating income before the depreciation, that is 80,000 we can say. Then there is an increase in equity. Increase in equity means we are making some investment from the owner of the dal mill, that is 5 lakhs 44,000. Then there is a long-term loans received from the banks, like from the financial institutions, 65,000. Then suppliers credit, like the 15,000. So total long-term loan received in the financial year, that is 80,000. And there is an increase and decrease in the short-term loans, like 6,000 we can say. We have received some short-term loan of 6,000 rupees. Then interest received, that is 3,000. So total, the increase or decrease in the account payable, that is basically the, and also that includes the short-term liabilities, like 6,000 rupees. So that is total in the 47,000 rupees, and there is no subsidy. So here total source of fund inflow is 7 lakhs 54,000. And then now we will calculate the outflows. The outflow means usage of the fund by the company. So basically here increase or decrease in the gross fixed assets. So 4 lakhs 50,000 we have purchased some assets in the, so there is a huge. And then repayment of the long-term loan. So basically we are paying the repayment of the long-term loan to the financial institution, that is 15,000. Then we are paying the suppliers credit, that is 5,000. So total repayment of long-term loans we can say are 20,000 rupees. Then there is an interest payment of the long-term loan, that is 5,000 we are paying to the bank as an interest loan. So that is also an outgoing fund from the company. So total interest payment is 5,000 here. And then if there is a loan commitment charges or fee is there, that we can include. So there is a total debt services which is equal to repayment of the loan and the interest payment or the loan commitment fee. So 20,000 loan we are paying and 5,000 interest we are paying. So that is the 25,000 total debt services we are paying. And then increase and decrease in the inventory, that is we can say the 1,67,000 rupees. And then increase and decrease in the account receivable, that is 68,000 rupees. Then we are paying the income tax, so that is 10,000 rupees. So total usage of the fund, the total outflow of the funds from the company is 7 lakhs 20,000. So here we can calculate 2-3 figures, like current surplus or deficit we can calculate. So in case of the current surplus, here is basically the inflow minus outflow. So total sources or total the fund received or minus the total usage of the funds. So here total fund received was the 7 lakhs 54,000, and total outflow or total use of the funds was the 7 lakhs 20,000. So total surplus or the cash surplus or current surplus is 64,000. And opening cash balance we are assuming here nil. So cumulative surplus of the company that is basically 34,000. And now we can sum up the session that the income statement presents the summary of the revenue, expenses and profit position of an enterprises, that is and the various through the various operations which are taken place in the accounting years. And the cash flow statements highlight basically the movement of the investment fund over the lifetime of the project. So basically it is the source of measuring the total flow of the financial resources into and out of an enterprise during an accounting period, and for projecting the future cash flow statement. So basically there are different financial statements we prepare, like balance sheet, the income statement and the cash flow statement, and basically they are reflected, they reflect the financial position of the business organization or business firm. With this, I thank you all.